Okay, now that you have the new copy, you have the title up here. So I go back to the original and I close it to make sure I'm not typing into any of the the template. All right, so now you come in here and you'll put in the address and you'll fill in these fields here. Population at the 1, 3, and 5 mile, square foot per population, and you can just go down here. Down here at the bottom, it'll have how many websites, and then does the facility we're potentially buying, have a website. And that's all you need to enter in on this page. So now we come down to the units. And this is where you're going to put in the units, the unit of the number of units, the dimensions, and how many of the units are occupied, and the monthly rate. In the first column, you just select the type of unit. And you'll see that they autofill over here on the stabilized section. This is the section on the left is the way the facility is run as of now. And on the right is going to be how we're going to change it to get it stabilized. In this one, I only changed the number of units occupied here. I bump it to like 45, and then to let people know that I changed it, I changed the color. I just go diagonal to the check mark and change the color there. So that will tell people that has been changed. And you can change the price also. If you want to bump it up, say 123, and then do the same with the color. Go to the diagonal of the check mark. So that'll tell everybody that you changed those units. And then down at the bottom, you can scroll down. And down here you have other income. Now this other income comes from leases that you might have. So you might have a cell tower or a billboard or a laundromat, anything that's not self-storage, not a self-storage unit. So you can, I usually just put one unit and it's occupied one, and then say the current lease is $1,000 a month. Same billboard, say that's $500 a month. And it brings it over here also. So you have your others. So that's all the information you need. And remember these units over here to the right are to get it stabilized. That's not pro forma units. Okay, so now you come over to the deal analysis page. And here you will put in any type of tenant insurance that it's currently receiving. Say it got $2,000 of insurance last year. Late fees were $1,500. So that's for the current year. And you can see how it brought over the gross annual potential income, and it also brought over the other actual income. The occupancy loss is calculated using the economic percentage here, which is calculated using the actual units that are in service that you put back input over here to these units that are actually occupied. And so now that gives you your effective gross income, where you add up all your current income and subtract out your occupancy loss. And down here you'll put in what they want for the facility. So we'll just say they want $1,750,000. And we don't have an offer price yet. So to get a temporary offering price, we can look up here to our my cap area where we get a value based on the cap rate that we put in here. So we'll just stick in $1,500,000 for now, just to get us a value. So now we come down to our expenses, and you can see up here in cell A4 you have a selection box. Now in this selection box you want to determine how you want to calculate your expenses. The first option is just calculating based off the EGI, which is also known as the revenue, which is the top row up here. And usually we use 35% to 40%, can go up to 50% for existing expenses. We'll leave this at 40% for now. And you can scroll down and see that the total expenses down here is calculated out based on the current expenses. Now once you refine things, you can go ahead and change it to detailed expenses. And then when you're ready to get an exact number, you can get the OM and put in all the information for their existing expenses in column E here under current. And then you come over to column F, and in that column you put out what you project your expenses are going to be for year one. And then after year one and year two, column G, it increases the expenses by the percentage you put in cell B6 here. So that will account for inflation of your expenses. And down at the bottom here, you have an asset manager and a management fee. And those are calculated using these two cells up here, B8 for the management fee and B10 for the asset management fee. So if we want, say, 2% for the asset management fee, we'll just put that in there. And you'll notice that it doesn't have anything for the asset management fee in the current year. So that will be the numbers they put in the OM if there is any. So now we want to calculate our property taxes. So you'll need to go to the county treasurer or the assessor's office and get the tax records for the property you're looking at, if possible. And if they don't have a tax records online, you may have to call the county assessor and get the exact assessment ratios and the millage rate, which is also called the levy rate. And then that'll calculate your exact annual taxes, and that value will be put in up here under property taxes. So now, since we're putting in detailed expenses, I'm going to go ahead and enter in some data in these fields. So now, with all the data entered, you can see how the numbers are calculated out and summed by each column. And with the correct offer price of 1.5 million, we get our calculation for the correct property taxes. Now, we don't use the property taxes that they give in the OM, because once the property sells, we'll be paying these actual taxes. So now you can come back to the deal analysis and see how your annual operating expenses has changed by percentage, and if the value here for my cap rate increases or decreases by a whole bunch, then you can adjust your offer price to better match that value. Now, capital expenditures, that's going to be any type of extra money you want to put in to add things, repairs to the facility up front. Say we want to put in like $50,000 worth of work after we get in, like adding a gate or anything like that. Now, the 7.5% we put in is for due diligence and closing costs. Working capital reserves is a percentage of operating expenses. So we use a 50% number of the annual operating expenses. That'll give us 6 months worth of working capital. In case something goes wrong, we can at least cover our expenses. And then the acquisition fee is paid to the individuals that actually acquire the facility and do all the due diligence work, doing the legwork for getting the loans. And coming down further to the down payment, this is the amount percentage you think you're going to need for a down payment, and that is calculated off this total cost. So you're doing 30% of the total cost for a down payment here. And then that calculates to the loan amount you're going to be needing to get. Then that loan amount is divided by our offer price of what we bought it at to get the actual loan to value percentage. So in this case, we are getting a loan to value of about 81%. These blue areas are our bank terms. So we're looking to get an interest rate of 7%, an amortization of 25%, and we're saying that we're going to close the deal and start on January 1st, 26. And so now that calculates out to get your annual debt service of around $103,000. Now if you come down, this is going to be what the current matrix looks like. At a 7% cap rate here, the market value is $1.5 million. You'll be getting a cash-on-cash return of 1% and a debt service coverage ratio of 1.05, which isn't terrible, but the banks want it to a 1.25. Okay, now we come over to this section over here, and this is the upper section is for the stabilization and how we're going to get it stabilized. So after we buy, we're going to implement it. Tenant insurance, say we get $5 and we're going to get like 50% of the people using it, and that calculates out to your tenant insurance. Late fees is calculated using this percentage down here. It's 2% of the units that will have a late charge on them. And then the occupancy is calculated out using your stabilized values back here on the units mix. That's how those totals are calculated. And you get your new figures, your new net operating income for being stabilized. So now down here, this blue cell here is used in the pro forma page for your annual rate increase. So that percentage is used over on this pro forma page to calculate all these increases starting in year 3. The reason we do that is that's going to allow us year 1 and year 2 to get it stabilized. The numbers in year 2 are used as the stabilization numbers, and then your pro forma will take place after starting in year 3. So on the deal analysis page, we say there's going to be a rate increase of 3%. And then this section down here is used to refinance. So after you get the facility stabilized, you want to refinance. And to refinance, we use a loan-to-value ratio of either 70 or 65%, depending on what the banks will offer. Sometimes they'll only do 65%. Sometimes you'll only want to refinance like 50%. So it just depends on what your business plan wants. The refi year is the year that how many years you will be running the facility before you refinance it. So this one we're going to refinance in year 5. And then the cap rate at the time that you refinance. So these are projections that you'll be using an educational guess on. So basically it's we're saying we're going to refi at a 7%. The interest rate when we refinance is going to be 6%. We're going to have an amortization of 25 years on that. And that loan value at the time of refinance, and it'll give you your new debt payments each month and your annual debt service at $96,000. And in that aspect, that's how you do all the data entry to come up with your summaries. And if you come back to the summary page, you can see your deal analysis here of basically what you're getting. So the offer is your offer price and the current information as the facility is run today. So here's your cash on cash of 1%. The value is $1.545 million. And the equity is how much equity you're getting with a purchase price of $1.5 million. Then after you stabilize it, you'll see your stabilization numbers where your debt to service cover ratio is 1.22. Now you'll want to try to get that up to 1.25. Your NOI, your annual debt service, the cash flow, and this is your cash on cash return at stabilization. And then this is the value at stabilization. And this is the amount of equity you created just stabilizing the property. And over here is your year 3 and year 5 analysis. It gives you value given at the market cap of 7% and the equity created in 5 years created $400,000. So once you have all your numbers entered in, you'll want to test your facility to see how it performs under different economic situations. So we come down here to our stress test tab. And the main focus you'll be looking at is these upper two sections. The comparison of all evaluation scenarios and all the valuations. Over here you can see it brings in all the main numbers that you're going to be needing to compare once the economic situations change. So you get your gross income, your effective gross income, your operating expenses, and then it calculates your NOI and your debt service, and then it comes up with your cash flow you're going to be getting for all these different scenarios. All right, the first column here gives you all the numbers that you entered in for how the property is performing currently. And then the second column calculates the stabilized numbers that you entered in. And this is based off year 2. And then the third column is your pro forma. And these numbers are based off the year that you're going to be refinancing, which is entered in under your deal analysis refi year. And now these last 4 columns, they are going to be your different economic situations. So you'll notice here that they have a superscript. Eval if full is 1, 2, 3, and 4. Now, in order to see what each one does, we'll scroll down here to the bottom, and you have these descriptions of what each economic situation covers. So situation 1 is you evaluate it if the facility is full. And usually you'll put this at 100%, but it may be something like 95%. Because if you're using a unit, or if your property manager is using a unit, it won't be calculated in any type of income. In scenario 2 is going to evaluate if the economy collapses. And that is defined that if the rent rates go down by 20% and the vacancies go up by 10%. And those are based off the stabilized values. And you can change these here to make it even worse or better, depending on how you think the facility will perform during an economic collapse. In scenario 3, this will analyze the facility based on what would happen if the market rates of the general area goes up by 50%. And you can see where that takes effect here in the valuations area. This yellow area will add 50% of your purchase price market cap. And then scenario 4 is what happens if the interest rates go up at the time you refinance. And here I put in a default of 1.5%. And you'll see here it adds 1.5% to the interest rate of your purchase price terms. So now let's see what to look for in these different economic situations for the valuations. So under the valuations, there's certain benchmarks we want to hit. So the first row here is our target cash on cash return. And that is the cash on cash return for the year. I usually look for a 10% cash on cash return, but you can change it to a 7 or 8, and you'll see how once the benchmark is met, it'll get rid of the red notification. And then the other next benchmark we look at is our total return on investment. So I usually look for 100%, but sometimes you may want to look for more, like maybe 150%. And you'll see if it doesn't meet that benchmark, the cell itself will turn red to notify you that it's not meeting that benchmark. And so the deal cap rate, you want that to be larger than the market cap rate. And the deal cap rate is calculated off the market value that you purchased it at. So this is telling you how good of a deal that you got. So the higher the deal cap rate, the better the deal that you got. And then our debt service coverage ratio, that is for the banks. Now, the banks usually are wanting a 1.25 value to make sure that you have enough cushion to cover your annual debt service. Now your sale price or refinance row, the first two columns, that's your sale price. The last 5 columns, that is the cash out value that you'll receive when you refinance. And then the market value shows you what the market value is under the current market cap rate. So let's see how this project performs under each economic scenario. So when we refinance, the market value of the facility is $2.28 million. And when we refinance, we're going to refinance at the value here, loan to value of 65%. And this is the cash out you will be receiving based on our pro forma numbers. Now, if it goes full when we refinance, we come down here and we see our market value has gone up to 3.2 million, and we'll cash out a 1 million. And you can see all these other benchmarks are met. Now, when the economy collapses, our gross rental income will come down and our occupancy rate will come down. So here you see we have a negative cash flow. And if we did refinance, we would have to pay at closing. So in this scenario, we will not refinance. So our debt service will stay the same, but we will still be losing money on a month-by-month basis. Now, if the cap rate falls, which means it actually goes up, that will reduce the value, the market value, when you refinance. In this case, it will also be a negative number, so we won't refinance again. But in this scenario, you're still making money. You're still running a positive cash flow. And if the interest rate goes up when you refinance, we have it going up to 8.5%. That's going to affect your annual debt service. And here you want to look at your cash flow again, and here it's green, so it's still positive. But your debt service coverage ratio is 1.11. It's not meeting the benchmark, so the bank may not let you refinance. And you can go through and change these numbers at the bottom to fit the criteria that you think will happen, and just see how your facility performs in different situations. So once you're comfortable with how the property will perform in different economic situations, we need to come down to the Deal Structure tab. And this is going to help us come up with the correct numbers to propose to the investors and get the numbers to a place where it will be enticing for investors. So if we come to our equity breakdown, this is where it's going to break down between the general partners and the limited partners. And it's going to be based off the buyer equity, that is basically another name for your down payment. So right now we have a structure of the general partners will put in 5% or $25,000. And the remaining amount is going to be 95% to the limited partners. So what you're shooting for is to get a 2x for the limited partners. That makes the deal enticing enough for most investors to take a deeper look at. And you can change these around. You can see how it changes the 2x goal. So if we come in and say the general partners want to put down 10%, that actually increases the limited partners' return. Now the bottom portion is the ownership breakdown. The ownership breakdown is how the cash flow is going to be distributed on a monthly basis. So here we have general partners getting 15% of the cash flow and the limited partners getting 85%. And you can change these numbers around also to get close to the 2%. So once you have these numbers figured out to come up to close to 2%, we come over here to the equity split tab. And in this tab, it's going to give you a breakdown of how an investor's contribution is going to perform and the dollar values they will be receiving. So here at the top, we're going to do a deal. Under the deal, you can give the investors a 5% preferred return. And what that does is it gives the investors 5% of the cash flow up front guaranteed. And then the remaining cash flow is going to be distributed based off our investor split. So the investors get 80%, which is what we put over here, down here in our ownership breakdown. Investors, the limited partners, are getting 80%, and the operators or general partners are getting 20% of the cash flow income. And then our next variable under the deal is the year to start the distribution. Now, sometimes we don't want to start paying off the cash flow at the beginning because sometimes you're not making money, or you want to keep the capital in reserve just in case something goes wrong during the build out. So here we have our distributions starting in year 3, but you can change that to 4 or whatever year you want to start your distributions. And then down here, our investor scenario, the variable here is what will happen with the amount an investor puts in or contributes to the project. So here we can put in, here it says $20,000 of the investor's contribution is close to 4% of the total capital raised. And here is how they will perform or annually. The annual preferred return will be $1,000, which is about 4% of the annual preferred return. And then on a quarterly distribution, they're going to get $250. Now, when they refinance, this scenario, we're doing it in year 5, which you can see highlighted here. The total cash paid out is $18,836, which is this cumulative return. And then the investor return on investment is 94.2%, which is the cumulative cash on cash return. Now, some investors like to look at the internal rate of return, and that's given here at 7%. So based off this $20,000, they're going to get their money back somewhere in year 5 before year 6 is over. And that is the process I go through to underwrite a property.